the Fed closely watches. Ryan Lemont is the CEO and co-founder at Neo Vision Wealth Management. And all of this as we get equity markets, which didn't do well last week, but have been doing fantastically and going at a great clip. So, Ryan, what is your interpretation of the mood music coming out of the Federal Reserve?
Hello, Rish. Well, the Federal Reserve clearly has stated and has been stating it's higher for longer. And I think Jackson Hole was very important, where Jerome Powell has said, keeping at it, which were Volcker's words. I think the Fed can feel that energy prices going up will affect inflation. They haven't fed into gas prices there yet, but they will. So inflationary pressure is there. On the flip side, if you look at the basically Treasury policy, it's expansionary. Since $33 trillion of debt were crossed, the U.S. has added $830 million per hour of debt. This is inflationary, and it's acting against the Fed.
Well, so what is your takeaway from this? Because you're not looking at the market as others are, because, I mean, if you look at how the equity markets in the U.S. have behaved, particularly the S&P and NASDAQ, you've got the Magnificent Seven. The other parts of this market are not doing very well, and they are showing some cracks here. Do you think that they are really reflecting fundamentals, or do you think they've just been left behind?
Precisely, Rish, and that's why we've been away from the U.S. stock markets since spring of 2023. We do not invest into a market that we cannot explain. The S&P 493 is flat over the year, which is what we expected. Small caps, Russell 2000 tech, divided by the S&P 500 is at the lowest ever recorded. So we do believe that the rest of the stock market is reflecting correctly fundamentals, interest rates above 5%, deteriorating U.S. economy, much more than the Fantastic Seven, absolutely, and that's why we're away from it.
So, Ryan, then where have you been allocating?
So we've been in Japan, in Brazil, Saudi Arabia, UAE, some private equity deals, and cash. Cash is paying us 6% at the moment. So 40% cash is paying 6%, which is beautiful to minimize the portfolio risk. We went out of Japan back in June, earlier this summer, because we weren't sure where the Bank of Japan was going to go. And now we're getting back in because we think that the Japanese yen will be capped at 150. And we think now it's going to pick up again. We are looking very closely at China, looking for an entry point, though it's not very sure yet. We think it has bottomed, and there could be an opportunity to get back in. Brazil, Saudi Arabia, UAE, the performance of the portfolio has beaten the Fantastic Seven.
Well, it would, also given the price of oil going up. So, how do you play that? Because how much of it is already priced into these company stock prices?
Well, absolutely. We do believe that oil is heading to $100. That's something I discussed with your colleague Manas earlier this summer. I said that the second half of the year, oil prices are going to go up. Japanese stocks, if the yen is capped at 150, so if there's an intervention, and I think Secretary Yellen has given the green light for that a few days ago, saying they expect the Bank of Japan to intervene, I think in the dividend-paying Japanese stocks, there is value there.
Well, and, talking about the oil price here as well, what we've got also is a lot of industrial action, aside from, of course, perhaps this resolution of the Hollywood writers' strike. But, in other parts of the economy, particularly UAW and other unions, have become more and more vociferous, seeing that their disposable income has been eroded because of inflation. Does this now create a new form of a demand pull inflation at the same time as we are having cost push from the higher price of oil?
100%, Trish. So there's a big shortage on the supply side. There isn't enough being invested in the infrastructure of oil, whether upstream or downstream, knowing that 75% of capex into oil is replacement capex, just replacement capex. So yes, oil prices are going up. And it will feed into inflation. In the history of inflation, we have never had inflation that high in just one cycle. We just finished the first cycle of inflation. We do expect a second and potentially a third cycle of inflation. And this time, as you rightly mentioned, demand pull and energy driven. Absolutely.
Final question. you've got to be brave to invest in China. That's the general consensus. Are you being brave, and will you be brave?
Yes, we will be brave in a very small allocation, being very, very cautious in how we do it. The real estate market in China is still unfolding. We've seen an announcement by an ex-Chinese official saying even if 1.4 billion Chinese go and rent or buy houses, there will still be oversupply. This is concerning. But we do think many of the Chinese stocks have gone to values that are absolutely no-brainer to buy, and we think they've bottomed out. It's still a very small allocation that we will build over time as we see data trickle in from China.
Ryan, thank you so much for joining us. Ryan Lamont, CEO and co-founder at Neovision Wealth Management.